Passive income investing through dividend growth stocks or ETFs are arguably the absolute best way to reach retirement at an early age, and this is for a few reasons. Number one, this is because dividend growth stocks have a track record of generating significant long-term outperformance compared to other investment vehicles. Also, investors can live off the dividends, providing a stable stream of income to support expenses through good times and bad. Whether the ETFs are up or down, it doesn't matter as long as the dividends keep rolling in and cover all your expenses. Now in today's video, we are going to explore an amazing combo of combining two powerful ETFs that combine the best of high dividend income on a monthly basis and extreme capital appreciation plus dividend growth. Now stick around because we are going to go over all this and more. Right after you, please drop a like in this video and subscribe for more content like this in the future. The powerful duo of high yield and massive dividend growth and price appreciation is going to be the VIG ETF and the JEPQ ETF. An investor would be getting the best of both worlds with a high-yielding dividend ETF like JEPQ, which would provide massive amounts of income on a monthly basis for an investor. But on top of that, an investor would also benefit from the massive capital appreciation and dividend growth from an ETF like VIG. Let's go ahead and dig a little bit deeper into both VIG and the JEPQ ETF and see what both the ETFs have to offer. So first, looking deeper into the VIG ETF, Vanguard says that the VIG product summary is the following. VIG seeks to track the performance of the S&P US Dividend Growers Index. The fund is passively managed, full replication approach. The fund remains fully invested. Large cap equity emphasizes stocks with a record of growing their dividends year over year. And of course, VIG has an expense ratio of just 0.06%, which is one of the cheapest ETFs in the game. Now some more key facts about VIG. The fund was created in 2006, currently has over $67 billion in assets under management, making it one of the largest ETFs in the world, and offers a trailing 12-month dividend yield of 1.9%. So this ETF does not offer the largest starting dividend yield at 1.9%, of course, but as you see, VIG has had some massive capital appreciation since 2006, and on top of that, stay tuned because I'm going to show you what this ETF has that many other dividend growth ETFs do not. Another very important aspect of the Vanguard Dividend Appreciation ETF is of course the holdings and the holdings breakdown. With VIG, technology is the largest portion of the overall portfolio at 22.71%, and because of this, technology stocks having a higher beta, this means that the fund is going to appreciate as far as price a lot faster when the overall market moves up. The next biggest portion of the ETF is financials at 17.66%, healthcare at 16.09%, industrials at 12.53%, consumer defensive at 12.07%, consumer cyclical at 7.38%, basic material at 4%, energy at 3.18%, utilities at 3.12%, and communication at 1.25%. The top 10 holdings in the VIG ETF out of the 317 holdings that the ETF currently has are some of the most bulletproof companies in the world. Now, all these companies have a lot of things in common, but a few of them being that they all do pay dividends. They've all, for the most part, had some decent or very, very substantial capital appreciation as far as share price, and best of all these companies have consistently raised their dividends historically speaking. Now, these top 10 companies are companies like Microsoft, Apple, United Health Group, ExxonMobil, Johnson & Johnson, JP Morgan, Visa, Procter & Gamble, Broadcom, MasterCard. And I want you guys to comment down below, what is your number one favorite top 10 holding if you were to have to pick one out of the top 10 holdings in the VIG ETF. Next, looking a little bit closer into this ETF's starting dividend yield and historical dividends paid. VIG has a trailing 12-month dividend yield of just 1.9%, which, like we said earlier, isn't the biggest starting yield in the world, but with an ETF that has the capital appreciation that it's had historically and the dividend growth that it's had historically, the starting dividend yield might not matter if you are going to hold onto this ETF long term. Now, what I mean by this is simple. If we look at the last dividend paid by VIG, as far as March 23rd, 2023, it was 75 cents per share. And this ETF does pay a quarterly paid dividend, but if you look back just a few years ago, let's go back to 2020, for example. This same ETF was paying 47 cents, 60 cents, 56 cents per share per quarter. So once again, now as of recently, it's paying around 87 cents, 75 cents, and just a few years back, it was paying around 20+% less per share per quarter. Now, if we were to go all the way back 10 years or so, this same ETF was paying roughly half of what it's paying today. So what that means in simple terms, for investors that, for example, invested into this ETF back in 2014, they are now receiving 100% higher dividends paid compared to their original dividend that they were receiving back around 10 years ago. Now that we unpacked all that the VIG ETF has to offer, let's dig deeper into the JEPQ ETF and see why I also think it'd be a great addition to this bulletproof ETF duo combo. So over here on the JP Morgan Asset Management website, it says JEPQ NASDAQ Equity Premium Income ETF. It says that JEPQ generates income through a combination of selling options and investing in US large cap growth stocks, seeking to deliver a monthly income stream from associated option premiums and stock dividends. This fund also seeks to deliver a significant portion of returns associated with the NASDAQ 100 index with less volatility. Now lastly, this fund constructs a long equity portfolio through proprietary data science-driven investment approach designed to drive the portfolio allocations while maximizing risk-adjusted expected returns. Now what's kind of cool about this is they actually have the entire investment process laid out on the JP Morgan website. So in more detail, it says that applied data science processes, utilizing 40 plus years of JP Morgan proprietary data to create a fundamental framework for security selection and portfolio construction. That's number one. That's the underlying equity portfolio portion of this entire investment strategy. Now with that, an option overlay. When it comes to options, 1 month out of the money call options designed to generate income and give investors a portion of the upside with reduced volatility. And with this, it equals JEPQ, a well-represented, fundamentally driven NASDAQ 100 strategy that seeks to provide clients with a monthly distributable income via option premiums and dividends. Now, some more facts about JEPQ. The fund has only been around for about a year and already has over $3.4 billion in assets under management. The fund's price is actually down since inception around 1.14%, so pretty much back to where the ETF started around a year ago. Now JEPQ's expense ratio is pretty much industry standard, or even maybe on the lower end for covered call ETFs for at least what I've seen, at a 0.35%. Now here we have the most important portion of this ETF, and at the top holding breakdowns. JEPQ has technology at almost 51% of the entire fund. Now with JEPQ's holdings being majority technology, that means that this ETF is going to have a much higher beta. Now this can definitely be a good thing, of course, when the market moves up. But when the market moves down, once again, something with a higher beta than 1 is also going to move down more significantly. But with JEPQ's top 10 holdings being things like Microsoft, Apple, Alphabet, Nvidia, Amazon, this ETF's holdings might have a little bit more risk as far as downside, but the upside potential, in my opinion, can be much, much larger. And when it comes to JEPQ, the upside is not only from capital appreciation. JEPQ also does pay a massive dividend on a monthly basis, or at least it has historically speaking. The most recent dividend from JEPQ was 36 cents per share. The one before that was 48 cents per share, 45 cents before that. And since inception, JEPQ's pretty much paid around the high 30s to around 50-60 cents per share per month. Now with the previous dividends paid, this gives JEPQ a 11.8% trailing 12-month dividend yield, which is obviously very hard to find a dividend yield even near that. So because of JEPQ's potential for massive capital appreciation in the future, because of the higher beta, high quality basket of holdings that this ETF has, and on top of that, the significant consistent dividend that JEPQ has paid since inception, this ETF for me personally is a perfect staple to have in my long-term dividend growth portfolio. So there we have it, a perfect combo in my opinion that offers an investor both income on a regular basis and also massive dividend growth and capital appreciation all together. Now for an investor like myself personally, I tend to own many different dividend growth ETFs out there, some of them being higher yielding, some of them being lower yielding, but I enjoy having a little bit of everything in my long-term portfolio. But I want to hear what you guys think down below about this ETF duo, VIG and JEPQ. And do you think this would be a good long-term option for dividend growth investors? If you enjoyed this video, make sure to please drop a like in the video and subscribe for more content like this in the future. Thanks as always for stopping by, and I'll see you in the next one.